The process of calculating taxable income for corporate tax purposes. Calculating taxable income is an essential part of the tax compliance process for taxable persons in the UAE. The process involves two main steps, which help ensure that a business's taxable income is accurately determined. This step-by-step procedure ensures the proper application of tax laws, the appropriate inclusion or exclusion of various types of income and expenses, and the correct use of exemptions, deductions, and tax losses. Below is a detailed breakdown of how taxable income is calculated. Step 1. Determining accounting income. The first step in calculating taxable income is to determine the accounting income, which is based on the financial statements prepared by the taxable person. These financial statements must adhere to the accounting standards recognized in the UAE, either International Financial Reporting Standards, IFRS, or IFRS for Small and Medium Enterprises, IFRS for SMEs. The accounting income is essentially the net income or profit calculated according to these accounting standards before any tax adjustments are made. In the UAE, there are specific requirements for businesses based on their size and nature. Qualifying free zone persons and any taxable persons with revenue exceeding AED 50 million must prepare and maintain audited financial statements. These businesses are subject to more stringent reporting requirements to ensure transparency and compliance with the corporate tax laws. For other businesses, financial statements may not need to be audited, but they still must follow the recognized accounting standards. Step 2. Applying adjustments to accounting income. Once the accounting income has been determined, the next step is to apply the relevant adjustments to this income in order to arrive at the taxable income. This involves adding or subtracting amounts based on specific tax rules that account for differences between taxable income and accounting income. These adjustments include various elements, such as exemptions, income that is exempt from taxation under UAE corporate tax laws. Reliefs, tax reliefs that are available for specific types of income or expenditure. Disallowed expenses, certain expenses that are not allowed as tax deductions. Allowable deductions, expenses that can be deducted for tax purposes, such as interest and depreciation. The adjustments are made to ensure that the tax computation reflects only the income that is taxable and accounts for any tax-free income, disallowed costs, and deductible expenses. Submission of tax return. After calculating the taxable income, the taxable person is required to submit a tax return to the Federal Tax Authority, FTA. This return must be submitted within 9 months after the end of each tax period. The tax return is self-assessed, meaning that the taxable person is responsible for reporting their accounting income and making the necessary adjustments to calculate their taxable income. Along with the tax return, the taxable person must provide the following details. Accounting income, the starting point for the tax calculation. Adjustments, a breakdown of all the adjustments made to the accounting income, including exemptions, deductions, and any tax reliefs claimed. This ensures transparency and allows the FTA to verify the correctness of the tax return and assess the tax due accordingly. Example of calculation of taxable income. To further illustrate the process, let's look at an example of how taxable income is calculated for a taxable person. Example 24. Calculation of taxable income for C LLC. C LLC is a UAE resident company. At the end of its most recent tax period, its financial statements show an accounting income of AED 10 million. C LLC has made an election to exempt its income from its foreign permanent establishment, PE, located in country B. C LLC also has carried forward tax losses of AED 2 million. C LLC's accounting income includes the following items. Dividends received from UAE resident companies, AED 1 million. Income from its foreign permanent establishment in country B, AED 1,500,000. Net interest expenditure, AED 7 million. Entertainment expenditure, AED 500,000. Adjustments to accounting income. 1. Dividends from UAE resident companies. Dividend income received from UAE resident companies is exempt from corporate tax in the UAE. Therefore, the AED 1 million of dividend income will be excluded from CLLC's accounting income for tax purposes. 2. Income from foreign permanent establishment, PE. CLLC has elected to exempt the income from its foreign permanent establishment in country B, which amounts to AED 1,500,000. Since the conditions for the exemption have been met, this income will also be excluded from CLLC's accounting income. 3. Net interest expenditure. Interest expenditure is generally deductible for tax purposes. In this case, the net interest expenditure of AED 7 million is below the de minimis threshold of AED 12 million. As a result, the full amount of AED 7 million can be deducted from CLLC's accounting income, reducing the taxable income. 4. Entertainment expenditure. Entertainment expenses are subject to limitations for tax purposes. Only 50% of entertainment expenditure is deductible. Therefore, CLLC can only claim AED 250,000, 50% of AED 500,000, as a deductible expense, and the remaining AED 250,000 will be added back to the accounting income. Calculation of taxable income. Now, we can calculate CLLC's taxable income by applying the adjustments. Accounting income, AED 10 million. Less, domestic dividends, AED 1 million. Less, foreign pay income, AED 1,500,000. Add, net interest expenditure, AED 0, no change as the full amount is deductible. Add, entertainment expenditure, AED 250,000, 50% of AED 500,000. Taxable income is equal to AED 7,750,000. Using carried forward tax losses. CLLC also has carried forward tax losses of AED 2 million, which it can use to offset its taxable income. The tax loss relief is limited to a maximum of 75% of the taxable income for the period. 75% of taxable income, AED 7,750,000 by 75% is equal to AED 5,812,500. CLLC's carried forward tax losses of AED 2 million are less than AED 5,812,500, so it can fully use the AED 2 million of tax losses in the current tax period. After applying the tax losses. Taxable income, AED 7,750,000. Less, tax losses, AED 2 million. Final taxable income is equal to AED 5,750,000. CLLC's final taxable income for the period is AED 5,750,000, and this will be the basis for calculating its corporate tax liability.